Good afternoon. We'll get started here on our third segment of crop insurance information. Hopefully all of you guys are surviving the cold weather we've had and the stormy weather. I know it's warming up here nice in Wisconsin, and the weather is getting nicer, so it all, looking forward to spring with the weather getting nicer. So what we're going to talk about today is some more insurance information. The first thing we're going to look at is insurance pricing. As of this morning, the corn price, we're at $4.53 average. Then what I did is I took ECO at 95%, that's a $4.30 price. At 90%, we're at $4.08. And the SCO is at 86%, that's $3.90 of the corn price. The soybean price is $11.70. ECO 95 is $11.12. 90% is $10.53, and SCO 86% is $10.06. We only have what would be 5 days next week, and today and tomorrow, so we're over, 2/3 of the way through this pricing, setting period. I think we're definitely going to stay above $4.50 corn and $11.70 soybeans. We're going to have some really nice, spring pricing for a change on these crop insurance programs. So what we're going to do is today is we're going to go over, trying to bring the whole picture together on, what we should do for coverage. Right here, I just use a McLean County, Illinois corn quote. What I'm really just showing is what the pricing is. We're going to use a 200 bushel yield. They have an ECO expected yield of 212. In Illinois, we talk a lot of 85%, $16 an acre. SCO is $28 an acre, and as you move down on your MPCI, the price goes down, but so does your per acre coverage. All I'm showing here is I also compared it to Webster County, Iowa. When you look at the prices, are pretty similar for the coverages that you get. I just did this as a reference points because we're going to use mainly the Illinois example for my examples we're going through today. Corn my thoughts on corn insurance are here. If you want to insure up, we're looking at 85% MPCI, 95% ECO. Your total cost is going to be $44.37 cents an acre. The total cost, and we're going to use 75 acres of corn in this example. The reason we're using that is for every 25 acres of corn, we're talking 5,000 bushel of, expected grain to harvest. When we look at our insurance commission totals, it's something like this. We're gonna, the insurance commission is gonna run around $6 on this. Our 636 total, about $8 an acre. We call the 85, 95%. We call that insuring up, maximizing your insurance. We look at 80% insurance. We're talking $727 an acre for $723 acre guarantee. Your total cost is $546. And you look at for the commissions, we go down to $171 and $228 an acre. Then we're also going to, when we're doing through our examples, we're going to look at a 5,000 bushel corn put. I use $4.50 at 42 cents a bushel. This isn't totally current, but this is going to be pretty close to where we're actually going to be. When I look at the total cost of that put, I'm spreading that cost over all 75 acres, even though we're only going to use it on a third of those acres. An option commission cost, we figure, you can usually figure like $0.015 per bushel per turn, for turning that. So when we start looking at the examples here, we have marketing plan options, we have the do nothing plan for, just the insurance plan that, we're not going to do much on marketing. We're just going to use our insurance for the price protection. For those who subscribe to our report and talk to us on a regular basis, we really like our third plan with insurance. Like on corn right now, we'd sell a third of the corn sold cash at $4.50. Then we do options on a third of it, and then we do nothing at this point. So when I look at this, and we start looking at the scenarios and the net revenues, that happen on this, I'm going to go through more than a couple, scenarios, on what's going to happen with price and yields. The first thing I'm going to look at is a fall price of $4. We're going to go with flat yields. If you're buying ECO, 95%, your net revenue per acre is $811. Cost is $55 an acre for that. And when I'm looking at net revenue, I'm taking out our insurance costs and any of our marketing / option costs on that. When you go with our third plan with 80% insurance instead of the 85% insurance, our net revenue is $831. So with the flat yields, we're looking at about an extra $20 an acre, in that scenario. Where it really starts getting, the differences is that really, I like the ECO and I like the SCO, The problem that we run into though is with falling prices, we usually tend to deal with yields that are going up. So like in this scenario, I'm going to use a fall price of $4 and yields are up 10%. So when you go to the do nothing insurance plan, your net revenue is $836. We're picking up extra revenue with our extra bushels. When you go back and look at our third plan with 80% insurance, our net revenue per acre is $911. So when you look at, we're getting, prices down and we're getting yields up. I mean, the difference between a marketing plan and an insurance plan, at 80, we're almost at $80 an acre. That adds up pretty quickly over a lot of acres. Then I did the same thing at the 375, yields flat, and then at 375, I did yields up 15%. You look at the net revenue, the same thing. The third plan is going to pay a little bit more than the insurance plan, and then the difference really gets different is when you look at the net revenue compared to the two of them at 375 bushel and the yields are up 15%. We're at over 100 acres of difference. So if you're farming 500 acres, that's $50,000. That tends to be, a big bump up in revenue. Where we do see more money in the insurance plan than the third plan is when prices go up, yields are flat, or, in this situation, we're going to go prices are up 50 cents a bushel, but yields are down 10%. When you look at the top scenario, the net revenue on the insurance plan is $956. On the third plan is $932. When you go down to the bottom and yields are down 10%, then we do see a big disparity, between, the do nothing insurance plan of $905 per acre net revenue compared to the $833. When you're going through these, so there's a big difference there. It's kind of opposite of other ones. When we always talk about risk management, the biggest thing, risk management is, to the downside. So we go back knowing your cost of production. It's just so important to know what levels you got to be at to make a profit and farm another year. The one thing you see also when you go to my charts here is under that net revenue, there's two different per acre on the do nothing plan. Well, 905 would have been the 95% ECO. Then the 874 is a 90% ECO. I just showed them both in there. When the yields are flat, it seems like the 90%, you gain a little bit more. You got to remember though the cost for doing 90% ECO compared to 95% ECO saves you about $18 an acre. So when it comes to final thoughts on corn, the biggest thing you got to remember, the 95% ECO protects 18 bushel of corn. So really you're protecting that area between 95% and 86%. So that cost comes down to about 64 cents a bushel. When you look at a 450 corn put is 40 cents a bushel or thereabouts. Then we look at a 430 corn put is 28 cents a bushel. You got to remember 430 is 95% of the 450, so that's really comparing, ECO with what a put would cost. I really do believe at these 450 prices that we have a high probability to pay on the ECO. I don't like the cost of the ECO though. I just think it's a lot of money to risk out there, when you're way better off, using that money on a marketing plan or buying options in your own insurance. ECO concern is when prices may be down, but, yields will be higher. That's always, that's just a fact of life. In most areas when yields are, down, prices are down, that means yields are higher. We do have secluded areas, but, that's more of the norm than anything. I would consider SCO and ECO in counties with higher target yields. I just think where your yields are higher, the chances of coming in are better, and you all know your, particular areas better than we do. We need to think average yields. Until we know differently, we can talk about a drought or too much rain or a bad fall, bad spring, but, we just don't know what it's going to be. So we always want to, consider that we're going to have average yields. The biggest thing is, we like marketing grain ahead at these prices. We're at a higher level for the insurance, and we've been in 5 or 6 years, and at 450 corn, we just think a lot of producers are very profitable at those levels. And the final thoughts on my corn here is, do you want deeper coverage or do you want wider coverage? So what I mean by that is, when you buy ECO, you're getting 95% coverage pretty much. That's $44 an acre. When I look at wider coverage, are you going to buy 75 or 80%? Then you want to buy hail insurance or wind insurance, or replant coverage on top of that. I really think it's, a good thing to look at those. Would it great being having 95% coverage? Absolutely. at $44 an acre, if you want to use a $450 to $500 acre cost before land cost, 10% of your cost is insurance, which I just think is a little bit on the high side. If you want to add, hail and wind and replant coverage on top of your MPCI at $7 an acre here, you're talking 15, 20, and then you're actually covered for a lot more different things. It comes down to buying 75 or 80. To me, you got to know what your guarantee is, and you want to, buy based on your acre guarantee. Then you look into extra coverage, and we just like our third plan. The big thing is you just want to, keep it simple and market some grain ahead and make some money. And I'm going to do the same scenario on beans, that we did on the corn. I think actually from a price standpoint, we're a lot higher on beans compared to corn. You've listened to our other, webinars we've had. We think there's more, vulnerability with the soybean market to go down further than we do on the corn at this time. But that could always change too. But yeah, the 1170 price, right? That's a very nice spring price. On the soybean thoughts, we're going to use a 63 bushel APH. We're going to do 240 acres, and that just goes back to that, 15,000 bushel, number. Then I just go through the insurance costs, and the commission costs for each of them like I did before. The big thing is you got to remember from your insurance agent side, and, I'm an insurance agent, is, when you buy 85% and, 95% ECO on top of it compared to just an 80 or 75% policy, the commission, we're losing out, becomes $3-4 an acre. If you're farming a couple thousand acres, we understand where the agent wants you to buy more coverage and thinks it's a good idea because, the commissions are that much higher. When you look at buying a put, we just don't make nearly the commissions on a put as we do insurance. From an economic standpoint, from a profitability of business, we think you should be, buying more insurance is the best way for us to make more money. But for a long-term strategy, though, we want to, best take your dollars and spend them correctly to help you manage your risk. Here we just go back to, we're going to use the same marketing plans as we did before. I put 1160, I guess today, if you want to use 1170, you can, but, these numbers are going to get us close enough. And then here I did prices down to $10, yields flat, and then I did a yield up. When you look at the yield flat down to 10, either plan that you go with, the revenues are pretty close. On the third plan, we are at about $6 an acre more revenue. When you go down below, and the prices fall and yields are up 10%, though there you get your big swing. Net revenue, the third plan, creates about an extra $90 an acre revenue. We're here to protect price. It's hard to determine what the county revenue is going to be, based off yields and price. It's the same thing here. I just did the same thing I did here in soybeans. I did corn. It's the same thing. When yields are flat, the ECO looks really good. When yields are up and prices are down, the marketing plan just, it's not even close which is a better way to go on that, in our opinion. Here with the fall price and the beans are up, and the yields are flat or down, run into the same scenarios we do in the corn. The do nothing plan with the insurance is going to pay you more. It's the same thing, if you're, on the bottom side, if the yields are down, there is a little more difference. But when we look at this, so, the fall price is up and the yields are down 10%. That's just, I don't know how many years out of 10, but, we really got to think averages. So, this is a scenario that we don't, will it play out? Yes, but it's a very slimmer chance than the other ones. So my final thoughts on beans, the 95% ECO gives you an extra 6 bushel of coverage. The cost is $2.93. 1160 put is 71 cents. $11 bean put is 41. Then again, I believe ECO has a high probability to pay, and so does SCO. But I don't know if I like the extra cost and putting the risk out there, on the insurance side when I could use that money, in my marketing plan. We need to think, average yields again and market grain ahead at these prices. We'd probably be more aggressive on the beans. We just think, $11.50 soybeans, 1170 soybeans is a very good place to get a lot of bushels sold. And here it comes back to, to me, it's the deeper coverage, wider coverage, question, comes into play is, do you want wider coverage or deeper coverage? It just comes down to what your costs are that you want to spend per an acre. this example, the deeper coverage is going to cost you at least twice as much as the wider coverage. When I go back, between the 75 and the 80%, to me, it's, you got to look at the acre per guarantee, into extra coverage. And if the guarantee is enough, do you want to spend the extra money, to go up from a 75 to 80%? I mean, I would say in a lot of cases, I do like it with these prices. You just got to look at it right now and decide what's best for you. The one last thing I'm going to say about the insurance and the cost of insurance is, it all comes down to an actuarial. An actuarial is the person that's sitting in the basements of all these insurance companies, whether it be auto, crop. I mean, any of them, they're the ones determining the rates. I mean, insurance is expensive for a reason, because insurance companies want to make sure that they don't lose out. And as you can see, I mean, the average insurance actuary makes $108,000 a year. Well, that's a pretty good salary. So these insurance companies with these premiums they're going to charge are, they're betting the odds are with them and they're not going to lose. As always, if you have any questions on the insurance, contact me. On the marketing plan, you could call into the office. I mean, you don't have to buy, you could buy puts at a less, dollar value. You can put fences on. They do have a couple different options that you can do on these marketing plans. So, if you want to work on a marketing plan and getting some grain sold ahead and some ideas on that, call and talk to them in the office. If you have any questions on the crop insurance, the best thing to do is just to email, call me, or text me. I'd be more than happy to help you out with anything. Are there any questions at all? If not, have a good day, and see you later.